Hi, everyone. I'm Pablo, and I'm going to be talking today about institutional crypto and DeFi. Specifically, I think we all know how to operate in crypto as individuals, but not so much how it works for institutions. So I'm going to be sharing a little bit of what we learned in our journey going from individual investors into a fund. So basically, this talk is a talk about managing complexity. If you've been in crypto for a while, this is a story. It's quite familiar that you have this friend, and they go out and buy some ETH, and then that goes up, and they sell it, and they start buying new positions, and then they get into some other tokens, and then they discover the magic of DeFi. They buy the DeFi tokens, they provide liquidity, they get some gains, they get some losses. Then they get into derivatives, they get an airdrop, they get some gains and losses as well. Then you do staking, then you do lending, and what you have at the end of this is you have a huge nightmare because the tax bill comes and you have to think of, okay, what are my capital gains? Are there first in or first out, last in or first out? Are they short-term, long-term? Are they returns of working capital? Are they gifts like an airdrop? Are they loan interests? Are they work income if I'm working for some project? And that's even before you think about moving countries, because then you might be facing things like an exit tax. So basically, when you're investing, there's a lot of complexity. And that's when you're only as an individual investor, but things get even more complicated once you start involving your group of friends. So once you have these pooled investments, you start giving money to each other, you start joining the same projects, maybe somebody else gets it on your behalf. The complexity keeps growing and keeps growing. And maybe you decide to not stop at crypto, but to also start doing some stocks or some financial investments, and then it gets even more complicated. So at some point, you need to start building structures. So yeah, what I like to think is as complexity grows, you need to also evolve the structures that you have behind. And basically, if you're going to be investing, ideally with a group of people, you want three things from your strategy or like your structure. You want to have certainty on tax treatment, so you know that you can sleep at night and that you're not going to end up prosecuted for something you did wrong. You want ideally the ability to pool investments. So if you have some friends and you want to put money together, but there's a difference between pooling and also having multiple managers. Like maybe there's some people who are more active, others are less, and how do you regulate all that? So basically, I try to draw here like some image of what your portfolio could look like if you're doing all these things. So you have the crypto side where you can have assets, maybe you have options, maybe you're doing some DeFi operations, maybe you're taking part in projects, traditional finance, there's like the equivalent version of that, and it gets really complicated. So one idea to reduce this complexity and to really understand how everything works will be, okay, let's package it. Let's put all of this in a box. So we can think, okay, all I'm doing is I'm buying parts of this box, then I'm doing some magic inside, and I'm taking it out. And there's two ways to do that box. You can go from the crypto way, or you can go from the finance way. And the way I visualize it is like we're digging a tunnel from both sides. We're hoping to meet in the middle. So one way would be, okay, I do a DAO, or I do a token. I'm not going to talk about that now. What I'm going to talk about is the other path. So how do I do this as a company or as a fund, where there's already structures that we can reuse, and how do we incorporate crypto into that? So basically, the difference between a company and a fund is, as a company, you're having this business activity. So you're doing some activity with clients or providing services, and you're generating revenue from that. There's a different kind of structure that's a fund where you can pool investments, and it's more designed for this undertaking, like this collective undertaking where you're basically making a pool of money, and hopefully that grows one day, more in a passive way. So I'm going to be talking about the fund. And the way I like to think about the difference is, as an individual, you're in the single player mode, and everything's monolithic, everything's a lot simpler. When you are working as a fund, you're working in a multiplayer mode. So that means that your architecture needs to change, because you need to have the rules of the game defined between the different actors, the investors. But it also means that you can use these existing financial structures that meet already this criteria. So we said we would like to pool investments, check, like that's something typically a fund does. we would like to manage investments with a team of managers, so I can put people in jobs and they can take responsibility for the different things they're managing. And we want to work with ideally regulated financial providers, so we know that the tax people and the regulators are going to be okay with that, and they're not going to surprise us next year saying that, you know, we owe a lot of tax backwards. So here's this comparison sheet. In terms of governance, everything's really simple. When you're an individual, because you decide everything. You're self-sovereign. But when you're in a fund, typically you have a governance structure with directors who are taking the legal responsibility. When you think about daily management, it's not necessarily the same people. So you could have managers who are employed that could be the same people as the directors, but in principle, it can be separated. And when you're working with fiat, you have to make this transition from a personal bank to an institutional bank. And that means you're going to have access to a lot of new, shiny services that might be useful in different situations. But it also means that it's going to be a lot more regulated. So anything you do, you're going to have to be a lot more careful about it. In terms of wallets and custody, in the individual world, we have the SECs and we have wallets. In funds, we have slightly different structures. I'm going to be talking about the difference between custodian and these new solutions, these multisig, MPC, non-custodial wallets. We're going to talk about that. Fiat and on-ramp is similar. You tend to work with a SEX or a bank. Now you're going to be working more with a custodian or a crypto-friendly bank. And in terms of trading, that part, it's a little more similar. And finally, in terms of taxes, there's a huge benefit potentially to moving into a fund, which is when you're an individual, you're typically taxed every year for every operation you do. But some fund structures, if you design them properly, can allow you to accumulate those investments and pay only when you're taking that money out. So if you're having a very long-term view in investing, it might be a very good idea to look into making the institutional switch. So we're going to break it down. It's a lot of information. Same saying, we have this multiplayer mode that allows us to split the roles and give those to different people. So the simple case is when you have a private wealth fund. Basically, you're the investor, you're the manager, you're still doing the same things, but you're doing that in a regulated environment. That's a simpler case. But if you're already separating these things, you can also have different configurations. For example, you can say, well, some people are going to be investing, and some people are going to be managing, and some of them are going to compensate the others with fees. And maybe the promoter puts a bunch of their money, but maybe some other people just want to join passively and join the upside of those investments. So that becomes possible. And finally, you can separate it completely. So you can be a manager and you can have a great idea and a great strategy and simply sell that to your clients who will be investing. And then you're collecting fees from that. So have a lot more flexibility here. And when you talk about a fund is, it could be one entity, but it's typically more than one entity. And one configuration that's pretty common is when you have an investment fund, and that will be your vehicle, but that's very passive, and you're not allowed to have usually business activity there. So you're not allowed to work with clients. You're simply buying your ETH, putting your money into NASDAQ, whatever you want, and then hoping that that grows because you're making good choices. That means that somebody needs to manage it. And the way they're related is that the management company is managing the fund, and the fund is paying a portion of their fees to the management company. So you can have this separation, which again, can be very handy. Then once you're inside, you can now place your investment structure here, and you can say, cool, I'm going to do all these things, which have a lot of history in the financial industry. You can buy your stocks and your futures, and that's typically going to be packaged inside a broker. But on the crypto side, it's not so clear. So if you want to be a pioneer, I'm going to share some of the things we are learning. Again, it's not a secret, but there's not a lot of clarity out there. So basically, as I'm saying, you have all this brokerage, but what happens in the crypto side? Basically, you cannot hold these things yourself, because if you have a wallet, any of the employees that has access to that could basically take away all the funds. So the regulator is not going to like that. So you need to find a way to make them feel comfortable with it. These are a few of the solutions that are in the market. And basically, before I speak about that, I want to just cover quickly what an institutional bank does. So this is on the This is on the more traditional finance side. So an institutional bank is doing the usual things your bank will do, like deals with fiat. But in this environment, what it means is accepting the investments from your investors. So somebody wants to put €1 million, they take care of that process, they receive it, they send the money to your investments, you can pay your running costs, but they also have a responsibility in terms of AML and KYC. So basically, that bank is going to be a lot more involved with understanding where that money is coming from, because they have a responsibility. And that means that you're going to have to be a lot more careful about how you accept money. On the crypto side, not every bank has this, but some banks are starting to accept contributions in crypto, which is great, because if you have a lot of ETH, for example, some banks will accept an investment in ETH. So you can send your 1,000 ETH and get a percentage of the fund, which means that in some tax situations, you should be able to make that contribution and not be taxable for that. Again, not always. They will allow you to do some crypto trades directly in the bank, have options, and they will also be involved in the AML and KYC. Finally, there's a few other services that these banks provide, like FX hedging, stock custody, lending, and so on, but that's not the focus here. So going back to the crypto side, how do you hold crypto as a fund? The first kind of solutions are more custody solutions, like Coinbase Institutional. They have a few services, different names, where basically they have a managed vault. And that's a vault where they will hold the crypto on your behalf, but you basically can't do very much with that. You can only buy it and sell it, and sometimes they will have integrations for staking or lending or whatever, but you don't have the full DeFi support. And if you're in this conference, you probably want full DeFi support, so you can do all the fancy things that you do as an individual. So there's another kind of solutions that are allowing you to do this self-custody of funds. So I'm going to be covering two. Maybe there's more. I've only discovered these two. And what they allow you to do is have access to real wallets that are meeting the institutional requirements that you will have. They are already integrated with some exchanges, and they allow you to set up roles, permissions, auditability. So this helps regulators feel a lot more comfortable. The way I look at this is step one. Like, this is your friend making their first purchase in crypto. And it's a good first step to do. It's already hard. And this is step two, when you really want to get the full operations. So in our case, for example, we didn't go from the first moment into full DeFi, altcoins, whatever. We said, OK, let's go and do the most stable things first, and then we will keep adding complexity and functionality. So what do these tools offer? I'm going to talk again about Fireblocks and Copper. Basically, what they're offering is your own wallets, and they do this with a multisig that's based in MPCs, multi-party computation. So what they're doing is they're splitting the key into several shards, typically 3, and they say, OK, you're going to need at least 2 of these shards to sign the operation. So that means that the investment manager is going to be proposing a solution, and they're going to use something really similar to MetaMask or Wallet Connect, and they're going to say, look, I want to deposit funds in Uniswap, but somebody needs to approve that transaction. So now you're checking all the boxes of, OK, somebody's doing this, somebody else is checking, and it gives you this ability to use this, again, multiplayer mode where there's a lot more complexity. Thanks to that, you get full Web3 support. Full DeFi support is not as quick as if you would do it yourself, but it's practically the same functionality. These are relatively new companies. I mean, what's not new in crypto? They have 600 clients, 300, volume of 100 billion plus a month. And the difference between them is how they're managing those shards. So in Fireblocks, you're talking about a cloud architecture where basically they're storing them in different providers. They have one in Azure, the other one in IBM Cloud. I don't remember where the other one is. And basically, the key never comes together. So it's not something that you can replicate. But still, it happens in the cloud. So it's both faster, but some people might not want to have everything on the cloud. Where Copper has a different approach. They still have that ability, I think, but they're more based on offline shards, where what you're doing is you're having a device that has that ability to sign, and then you need to come together with the different the different signing procedures. So the way that looks is like this. So you'll have your solution, and you have the different vaults. They have some integrations. But basically, you will get actual wallets. And the signing process looks a lot like the typical extensions you look. I think this one's called Copper Connect. And basically, because multiple people need to sign, you need to define the rules. And maybe you say, well, if it's less than 10K, then we have the easy signature process. Or if we want something really secure, maybe we need more authorizations, or maybe this only goes to a whitelisted account. So you can really define your policies and implement the security level you need. This is one of the slides from Fireblocks on the Copper. So basically, you're trying to distribute those shards on different operating systems. And yeah, they have some approach to security, which I don't feel like, it's not my company, so I don't want to go into too much detail. But they're trying to provide enough security for these transactions. This is a screenshot of one of the tools. Basically, they allow you to keep these different wallets. They have some integrations with DeFi apps. They have some integrations with exchanges as well, which means that if you're going to be operating with Kraken or with counterparty like GSR for trades, if they're in the network, you're going to be able to do those transactions much faster with less counterparty risk. So that's in terms of tools. Then if you're thinking of setting up a fund, the main choice you're going to have to make is in which country do you set it up. There's a lot of countries, and I'm not a tax expert, but what we end up choosing is we said, well, look, we could go to an offshore thing. We don't want to do that. It's a bit shady. We prefer to work with somebody in the European Union because we're based here. So from our study, we chose to work with Luxembourg. Why? Because there's a huge tradition of financial structures there. It allows you to operate with Switzerland as well. So basically, you get the good parts of Switzerland and the good parts of Luxembourg. That's basically our choice. Everybody's going to have a completely different solution, and there's not a one-size-fits-all. But there's also other vehicles in the US and in different jurisdictions. What are the costs of doing something like this? Basically, lawyers are not cheap. So for this legal assessment, you're going to have to spend probably 50 to 200K out of pocket just doing that analysis, and that would mean going to every country from your investors, from the people involved, and giving you a good opinion. Because we're pioneers, there's not a definitive opinion. They will always say this will likely work. But you can get a lot more certainty. And then when you're running the fund, basically you're going to have running costs. For your bank, 20 to 50K a year, fund management, brokers. So you're talking about a minimum running cost of 100 to 200K a year, which means that if you're thinking of setting up a fund in Europe, for example, I would say the minimum amount that starts to make sense is about 10 million in assets under management. Again, that doesn't need to be fiat. That could be a contribution that you do in crypto. Once you get to 20 to 50, I think that's the ideal size for an unregulated fund because the expenses become smaller in proportion, but you can still do all the cool things you want to do. Once you cross the 100 million mark in Europe, there's a step where you're going to be subject to more regulation. And the more you can get regulated, the better, but it's going to limit the things you can do. So it's a balance between flexibility and having less friction. And when you go over 500 million, well, first, congrats. And second, you're going to have to get regulated no matter what in Europe. So that's a bit of an overview. If you're thinking about doing it, find us. I'm happy to talk about this and share our experience or contacts. What I like to think is you should think about what are your buckets. Is it going to be crypto only? Is it going to be a mix? Are you going to be a hedge fund and VC? You split that into buckets, and then you come up with a strategy where you implement complexity gradually. You shouldn't go from 0 to 100 on the first year. It's going to be very complicated. Something will fail. It will take forever. Just add complexity little by little and try to keep it simple. So 1 second left. That's my talk. Thank you so much. We're going to be around with the yellow shirts. Thanks for coming. Happy to talk. Do we have a minute for questions?
Yeah,
or?
We'll take one question from the audience.
One there?
So you mentioned a little bit about DeFi how do you get these funds interested in DeFi, and how do you reconcile the risk with them investing money into something that is quite risky, basically?
I think if whatever your strategy is, you need to be really transparent. So in our case, it's a private fund, so we take our own risk. But if you would be working with clients, then you should be really transparent about, look, this is the risk policy that we're taking and the strategy risk, and always think about the best case. I would hate to work with somebody who's putting their life savings, and then we lose everything from an accident or something goes wrong. So I think you always have to be really honest, and if somebody is not the risk profile that you're targeting, you should just discourage them from working with you. But that being said, we're very risk friendly. We wouldn't be here otherwise. And that's our strategy, yeah.
Thank you.
Okay, thank you so much.